Hey, everybody. I trust you're all well, and welcome to today's session. Now, here's something very interesting. When I look at all the markets, I think we have some potential moves coming up for the day. If you have any questions, guys, just pop them up into the chat box. So we're looking at the euro versus the dollar. Let's start off there. So that's our high of yesterday. And, the market is just broken out above that. Now, we opened somewhere within here, about 30 an hour or so, hour and a half or so ago. What would be going through your mind at the present moment? I'm just going to pop up the daily chart. I'll just set up another one so I don't put up the ones that are all cluttered. So if you look at the daily chart, this is where we are. So we've had a break beneath that low, that trading range. And of course, whenever we see a break of the trading range, we look at a potential measured move. And you always have to ask yourself, when you got the breakout, what kind of breakout did we get? So though we had a breakout, immediately after that, bull candle, inside bear candle, almost tried to break out, failed. Then a couple of bear candles, so good for the bears. And the measured move is down here. That's a measured move. Let's just put it correctly. Measured move of that whole trading range is down here. So there is still theoretically a lot more opportunity for the bears to push the market down. How would they do that on the daily time frame? All we need is the market to start to reverse anywhere within here. It can reverse today, failing to break out above yesterday's high, and immediately start to turn, which means, because we're seeing all of this bearish price action, which means our mindset is we've got to be looking for shorts, right? If we're expecting the market to turn, then we must be looking for shorts. Will it turn here? Who knows? That's what we search for in the market. Will it attempt to go and test the 10 EMA, which is the indicator of strength in any breakout, which means might happen today, big bull candle that turns at the test of that low, test of the moving average, or it might happen tomorrow. In any case, the point is, the euro versus the dollar, we are looking out for potential entries to go short. So now, drilling down to our trading time frame, just do that so that you can see high of yesterday. Always mark your highs and lows. Low of yesterday. That light blue mark, 50% pullback. Any 50% pullback of any trading range, whether it's yesterday's trading range or a short range that you see intraday, or you get a news announcement, you have a huge candle, then the market starts to pull back. You have to mark 50% of that whole range, because that is a magnet that the market tends to respect. So all of that are in place. Magenta purple line is our open of the day. So earlier on, clear trading range formed by the market at this stage. And you always have to say, well, if the bulls break out above that, which they did, how far do they want to go? The initial target, of course, always is the measured move. So that's original goal. That's where the market wants to go. And when we get there, if the market doesn't turn or tries to break out, you have to look at it bar by bar. That's what the simplicity of price action. What happens immediately afterwards? Well, we have a doji and the market goes sideways. Well, if we have a doji and the market goes sideways, at that point, you need to be saying, okay, I need to see more strength from the bulls before I even attempt to jump in. Why are we going sideways? If they were strong at that particular point, they should have continued with their breakout, pull back, and carried on. But the fact that we had a doji inside candle, went sideways, we came back, closed beneath the 10 EMA. Very important. So that's our indicator of strength. and the bears are able to put a candle that closes beneath the 10 EMA, you should be saying to yourself, there is a problem with the bull case. What is happening with the bulls? So you need to be cautious at that particular point. Close beneath the EMA, bulls had a chance to resume, we come back and we bounce off the 20 EMA. Now this looks beautiful, doesn't it? And hopefully you're not saying, oh my goodness, I should have jumped into that trade. Why would you not be saying that? Because every time, remember we've spoken about major trend reversals before, so there's a pretty strong trend. Every time you have a break of a trend, observe what happens at the EMA, we've spoken about that, bears have strength. At this particular point, put a close beneath the moving average, put another close beneath the moving average, and you don't take that trade because you don't know this is going to happen. Okay, you have a potential trading range that's forming, and if a trading range is forming, you don't want to buy into a trading range, into the top of a trading range. Okay, so there's a trend that has just been broken. Pretty strong trend, broken, bears are putting strength, fantastic. Now, at that point, you'll be saying, without seeing all of this, okay, if the bear case is strong, then the market, that's going to be a level of resistance. This high, where the market is 10, potential trading range been formed. The high of yesterday, if the bears are strong, they're going to defend that. And if they defend that and give us a double top, big tick, then we just wait for a lower high to go short. But it did not happen. So the bulls had a follow through. Now, when that happens, automatic things begin to happen in your mind. Low of the potential trading range that was forming. High, and that's the low. See, there's a low there. So that's a low, that's a high. If the bulls break out above that, well, now we know the refrain, the song. They expect to make a measured move. So we write at the measured move. Of a breaker. So we are waiting. Now, what are we waiting for? Okay, so the measured move has been reached, which is a breakout above this trading range. But the bulls had strength. It is the bull breakout candle. We had follow through candle. So now you're sitting there and say, well, this is pretty confusing. Which direction is the market likely to go? Well, when that begins to take place in your mind, when you suddenly get all these questions, it means there is a trading range that's forming, essentially an area of price agreement. So if there's a trading range that's been formed, that's pretty good news, because if there's a trading range that's been formed, we know whenever we have a trading range, we want to sell high back into the trading range. And if it comes down here and creates a double bottom, we want to buy low. Okay, so the key thing is we had the measured move, but let's wait. We got a minute or so for this candle to close if the bears are strong. If the bulls are strong, they just need to give us any small kind of bull candle up here. Then we know, okay, the bulls are strong. Then we kind of say, okay, fantastic, the bulls are strong. Now we change our thinking completely. If we get a second bull candle, we're now saying, okay, successful breakout candle, follow through, another little follow through above the measured move. Let's wait to see if we get a pullback. But we need to see how this particular candle closes. Let me just check. Hey, Richard, hope you're good, man. Trust all is good. If you've got a question, just pop it in there. Okay, so let's keep a lookout for euro at a level of resistance, just a breakout above yesterday's high. Another thing you could put in, which the more you do it, the more you just, so Fibonacci expansion. Okay, so where did the trend start? You could say the trend started there or the trend started there. So if we put that in there, okay, I'm not sure why my fib levels have changed. Anyway, so when you get the Fibonacci extension, Just set it up so that it gives you information that you want. Okay, we also want the 200. Okay, so do we have the 0? I don't know what happened to my 0. Okay, so you can say your trend started there. And common visualization parameters. Let's try that again. Insert Fibonacci expansion. Okay. Looking at the wrong thing, George. So if that's the leg 1, so there is leg 1. Where did leg 1 end? It would have ended on this side or with a pullback. And there is the pullback all the way down here. So the Fibonacci expansion tells us leg 1, pullback leg 2. So after the pullback, the bulls who created this first leg would like to create a second leg. So there's another potential level of resistance, which the market might turn at. So let's leave it at that, and we'll come back and have a look. All right, I'll get back to that question shortly. All right, so that's Euro. Now let's have a look at another one that's interesting. We're going to try and work through them. Hang Seng 50. I enjoy trading the Hang Seng 50. There's a few things I want to show you. So if you were in the market earlier on, and I think, guys on the eastern side of my African continent, on the Asian side, you'll have more opportunities because the sun rises first to your side. So you might have been looking at this market earlier on today. If you were, here's some interesting things. On the open, okay, when you trade in the open of any market, okay, so the Asian session is open of all the markets. So the same kind of thing applies. But also if it's trading a specific market that is specific openings, like we have with the Hang Seng 50, it's always important to look at the first candle of the day, because that gives you information of what is likely to happen. So the first candle of the day, that's the high of the candle. That's the low of the candle. So good enough candle for the bears. Market opened here at some point in the first few minutes. There was a bull candle, but then the bears reasserted themselves after this sell-off towards the end of yesterday and closed near the low. So that's good. There are patterns that we look for on the open. Okay, there are specific things we look for. A couple of times in a month, you get these gifts of days, these rewards. If you for just being patient and coming into the market day after day, you get a reward where we get a trend from the open. Okay, so either the first candle or a few candles later, the market just sells off all the way for the day. And man, if you're in it, if you're managing it, you make money. Even if you're in and out because you got to go to work, you'll pick up 1%, couple percent, whatever. So it could be a trend from the open, or a trend from open bear day, or a trend from the open bull day. Doesn't happen often, a couple of times. Most other times, we get trading ranges being created, we get trends in early parts of the session, we get reversals, and then they resume again when like the London session opens. That's another open must look out for. When the US open, US markets open, you also look out for those opens. But after the first candle, you must look at what's happening. Well, that's just to tell you stories. If the bears are strong, which they were on the first candle, they should have given us a follow-through candle, right? And after giving us a follow-through candle, then we know, okay, we have a potential strong trend from the open. We might get a pullback or not, but we didn't get that in this case. We had a pause candle, a doji candle. Okay, a doji is a candle, small body, tails on top, tails on bottom. That is a trading range. It is still a trading range. So that's what we got, followed by an inside candle. So we are in a breakout mode. Okay, markets will break out of a trading range at some point. If you get an inside candle, then that's an even stronger breakout mode. You know the market's going to break out. But most breakouts fail. If you were to write something down, you must write most breakouts fail. Okay, why is that important? Well, it just means don't go and take the first trade of a breakout. Okay, don't just go and jump in. So euro market is broken out because most breakouts fail. Don't jump in there and just see a breakout, just buy. You know it's likely to fail. There's a greater chance, 80-90% it's going to fail. So wait for the pullback. When you get a pullback, then you can jump into the market and take the trade. So we then get a breakout, but look at it first. As it formed at some point, the bulls tried to break out above that inside pattern and above that trading range. Let's just make sure. Just going to open it up a little bit. I had a look at it earlier on. That's why I think it's quite fascinating, because, and I'll tell you what I'm looking for now on this particular market. So that's what we're talking about, breakout to test the moving average. That breakout failed. Most breakouts fail. And then if we had a high test candle, bit of a tail, small body, but not creating an outside candle. If we had a candle like this candle here, that had formed here, that would have been a nice one for you to jump into the trade. Stop above here, 60% chance the market will sell down. If we follow specific strategies, we know we're 100% right. We're always 100% right, but only 60% of the times when we are trading trends. Okay, trends are the easiest to trade, the higher probability of success. So on your trader's equation, which is risk times reward times probability, risk you manage 0.5%, 1%. Reward, you know where to take your profit. Probability, if we're trading trends, there's a higher probability of success, and I'm always working on 60%. If I'm trading reversals, and I'll show you where a reversal would come in now, the profits on a reversal are a lot more because you're taking a trade before things have become clear. And if it works your way, there's a lot more profit. Whereas if you're taking a trend trade, if it's set up, everyone can see it, jump in, take your profits at 1-to-1. We did not get that here, but we still have an opening strong bear candle. We still have a high of the day that has been set up. We don't trade the lows and the highs of an outside candle because that's a trading range. So we're back again to say, okay, trading range, if the market breaks beneath it, it is likely to fail. So let's see if it breaks beneath it, fails, comes back, pulls back, gives me an entry. It did not even break beneath it. Immediately the bulls jumped in to try and reverse the market. But it's still a trading range, right? So we tried to break out above it and we failed. Bulls failed to capitalize on it. All they had to do was give us another bull candle. Instead, we had another trading range forming, a doji. Now, this is where it gets interesting. There's a lot of things taking place here, okay? And what is taking place here, that if you had been in the market at all of these things marked, you should be saying, man, woman, guy, whatever the case may be. Let's jump into the trade if it sets up. But guess what happened? It doesn't set up properly. But let's look at the things that are there. I put it down for you. I wrote it down here. The market is coming back to a level of resistance. But this resistance, it's a confluence of factors. There's many things taking place. Okay. So if let's use support to illustrate a point. if you had, okay, so just that piece of paper and something dropped on it, it's not going to hold, okay? It's not going to hold. But you had that piece of paper, you had something else beneath it, and I don't know, let's assume my calculator is supported. If you have multiple things on that, that is a strong level of support. Similarly, resistance, if there's one thing, the market can blow through it. But if you have a confluence of factors, a stack of factors, the market will bounce off that. And when you see a confluence of factors, you must put them down and just watch and see what happens. So what did we have here? Remember, we always put the low of yesterday, red line, high of yesterday way up there, high of the previous day, and the 50% level clearly marked. 50% level clear mark. So that's one level of resistance. Okay. We still have the high of the day clearly marked. We can see it. Let's mark it clearly. Okay. So that's the level of resistance. The market goes above that. The bears are going to try and defend that because the bulls tried to go above there in the beginning. They met a lot of sellers. That's why we had this candle. But we also have the low of 2020 that is right in that level. Now, it's going to look a bit cluttered, but I'm going to put it on the daily. Now, let's put it on the monthly. That would be easier. Okay, so that candle, the low of this candle on the monthly, that's one that I've marked as the low of 2020. And everyone knows what happened in March 2020. The pandemic kicked off, okay? And everyone, all of us told us that, oh my goodness, the market is crashing. It's going to crash until it can't crash anymore. But it was quickly repulsed. Now, here's what's interesting. I was talking to one of my traders just last night and talking about the war situation. If you put your charts on a higher time frame, there is no ways you're going to know that there's a war taking place. It's just price action, right? So if you didn't know that with the COVID pandemic, breaking out here, and we had that low, it's just have been, oh well, look at what happened. Market turned here, low, high, bears trying to test the low to break out, bulls repulse them. But it's still a level of support. So level of support there where we were, but if we come to present price action, that support is now resistance. Okay, so we broke through that support and that became resistance. So that's a pretty strong area that the market respects. There's also the open of the day, or DY, open of the day, that one. Okay. There is a 20 EMA, which is the light blue line. There is the high of the day. So you got the open of the day, sorry, the magenta, you can barely see it here, that purple line, but it's marked off the open here. Got the high of the day. Then you got the 50% pullback. So 1, 2, 3, 4, 5 levels of resistance. So pretty strong. So when you saw that coming up, you got to say, if the bulls are strong, just give us one candle above here. That's going to demonstrate strength. Okay, if we got the strength above that, then we'll start looking for bull case. But we had an inside pattern forming. Now, if you are trading reversals, that's where you'd be looking for a trade to jump in. Okay, reversals, low probability of success, which means you get stopped out more often, so you must manage your trades. But if they go your way, the returns are much higher than you would get than waiting for a trend. If you're waiting for a trend trade, you have to wait for all of this to set up and then maybe take that one inside candle, wait for a breakout, wait for a pullback. Okay, so point is that would have been the opportunity there. But now going into where we are, which is very important for looking at your chart, always look left. This level of resistance you must keep in place. So now we had a bear breakout beneath the low of yesterday and follow through, and the market went down. So fantastic. So in our minds now, we're saying there's a pretty strong bear case. Let's wait to see if we get an opportunity for us to jump into the market. So now just fast forward to where we presently are. And I should do this, yeah. Okay, so this is where we presently are. This was the breakout beneath that pattern. So now we are looking for opportunities for us to go short with this market. Okay, if we're looking for opportunities to go short, we have to see a few things setting up. We want to see, okay, so for starters, why are we going short? Well, have a look at this breakout here. The strongest part of the breakout, two successive candles, the first one occurred right here. Then we had a few more following through. But every time we had bear breakout, we had bulls coming back. Okay, so bear breakout, you have bull candles, trading range price action until you got the low. So fantastic, but this does not look like a very strong trend. It looks like a strong bear leg in a trading range because you have sideways price action. Because we never look, and that came back to test that breakout, and that's testing that breakout point. But there is no consecutive bull trend candle. So just as we had bear leg in a trading range, you now have a bull leg in a trading range. And if we have a bull leg in a trading range, unless we get successive strong bull breakouts that break above that, we are now thinking we're going to get another opportunity to go short. So we'll get another opportunity to come back into the trading range. Question is, where is it likely to happen? Okay, measured move, you can see that pullback. If the bulls accelerate above that, they can only go that far in terms of their initial objective. And they get to that for their initial objective, there's still those levels of resistance to break through. But for us, we got to stay alert. If the opportunity comes much earlier, we must jump in. So I have this on my list to go short. I'm really keeping a close eye on it. If the bulls come back and break above that, fantastic. I'm not worried. I look at the measured move to see if we get to that measured move level and then maybe turn there. If the bears are set themselves here, all I need to see is a couple of strong candles. Remember, this is yesterday's low, broken beneath it, broken above it. Just need to close beneath that. Pull back, give me an opportunity. So there'll be multiple ways it might set up. Couple candles closing beneath here, lower high, you look at the trade. Or might attempt to break above that, which is fantastic because it's breaking above the potential double top. So the market went up once, went up twice. So all of this is part of the double top. If it breaks above that, it's a third attempt to break above a particular level, which is our wedge pattern. Fantastic. We just wait for a lower high. So this again is on the short list. Let's have a look at it on the daily. So I'm going to avoid a bit of the clutter. So there's our market. Let's get rid of this stuff. Okay, there is the Hang Seng 50. So this is on the daily time frame for this particular market. I mean, you can just look at the bearish strength. Gaps all the way down. Okay, except last few days. Now we know that whenever gaps are created, at some point the market will try and reverse that those gaps. Gap here, that low, that high, closed a couple of days later. Gap here. Okay, took a little bit of while to close it, but eventually closed. So at some point, all of these gaps, the market is going to try and close it. But until then, we're in a pretty strong bearish market. Okay, so the level where it gapped down, there was a low there. So bears will be saying, okay, we gapped down that far. There was the objective, the initial objective, measured move of that particular trading range. Again, we had a gap beneath that. So that trading range, that low and that high is almost the same as that trading range, that low. There's no point in redrawing that. But you also had some pretty significant levels of support. And then, so if you're a bear, you'd say, well, okay, if we break beneath these levels there is a way, an area to take profits, but there's also this larger trading range, that double top and that low, and that becomes an objective. So you can see we're breaking below all the levels of support, which is good strength for the bears. So when you get here, when you see in this buying, it's not a surprise. Who is creating the buying? Well, for starters, the bears who have been selling all the way down here want to take profit at some point. So you take profit at a measured move, they take some profits, they bank some profits, and bulls who are strong, very strong bulls, large institutions, know all of these levels of support. They also will be starting to buy a little bit to see if they can turn the market. Okay, so the profit taken by the bears who are selling, they are buying. Then we also got some bulls jumping in the market, but it's still a very strong bear market. So we are looking for potential shorts in this market on our trading time frame. So that trading range that we looked at, the market went down, market came back up again. There's still the open that we were talking about and all these other levels of resistance. So what we're saying, let the profit taking take place. If the market starts to turn, the bears intend to create a strong bear candle to show strength to carry on selling, well, we are going to be ready for it. Okay, so that's what we're looking for in terms of the 5-minute time frame. Thanks, Richard. So Fing, I hope I'm pronouncing correctly. If not, my apologies. So the guys in the office will give you some ideas, some hints. Let's talk about it now, because we've just launched it. I've been trading price action for almost 13 years now. It's not 14 years. Think of my daughter's age, and I had a couple of years. That's how long I've been trading. I've tried all sorts of ways to trade. Eventually, I settled on just having EMAs on my chart, couple of EMAs, and that's all. And then reading price action, and getting all my information from what's happening in the market. So that's where I trade. It's just price action. There's no other way to describe, bar by bar, which is kind of the one of the subtitles we have for this show. What we have launched with the guys in the office is a product that I'm calling Wednesdays at the Market with George. So the links will be sent to you. There's a page that's going to be released to you if it hasn't already gone up. And basically, you can come and trade the markets with me every Wednesday. I'll be in the market for 8 hours, but those 8 hours are split between the first couple of hours of the open of this particular market, Hang Seng 50. But you look at all the 7 markets that I trade, they're down here, and see what's happened since the opening. Then after those couple of hours, I come back for a couple of hours, which would have just finished, before this particular session, the couple of hours opening of the London markets, and we look for opportunities like we're presently doing. Then I come back and look at the couple of hours opening of the US markets. And then at the end of the day, we're looking at the close of the day, but also how we've managed our money. So if we've taken trades, have we really managed our capital, the equity that you've put in, so that we don't just make 1% or 1-to-1, when by managing the money, we could be making 2-to-1, 3-to-1, 4-to-1. So that's my trading room. And in that as well, I think the guys will give you the links, just the sum total of our trade is what we'll be presenting and discussing. So I hope I've answered your question without boring you a little bit. So there's a lot of analysis. Now, what's interesting, I'm lucky enough to be invited by my colleagues, Jeff and Ash, and we've traded together forever. I mean, Paul B is a common factor, was one of my early coaches, but we've traded Jeff and Ash together. So they invite me to trading buddies on Monday. And I'm always, every week, I'm fascinated when I'm sitting in there with the guys, how the fundamentals, the way they look at the fundamentals and they explain the way they trade, how that correlates to price action. Now, I'm pretty boring. I don't read the news. I don't watch the news at all. I just stay clear of it, so I'm not biased. So when things erupt, it's pretty sad to say that I didn't even know there was a war building up. A few months ago, I didn't know that the Serbian guy was kicked out of Australia. I'm just looking at the market. So I love price action, and that's how I trade. So we're having a look at that. Let's have a quick look at another one. I'm going to see which one we should look at. Okay, so if you're going to come and look, if you're going to be trading the US markets, so S&P 500, of course, you can trade that all day, but I find it quite fascinating when you look to trade that when the New York Stock Exchange opens. So the US market open for me is from 3:30 p.m., which is 1:30 p.m. GMT, 9:30 p.m. if I'm correct, sync time. An hour later, the New York Stock Exchange opens. So between that 3:30 and the open of the New York Stock Exchange, there's some interesting opportunities that you need to be looking out for. So if you enjoy trading the S&P 500, look at it throughout the day, but always be aware that at the open, the market may change direction. Now, at each of the open, when you're looking at the markets with as they open, with the Asian open in my morning time, because I'm Central African time, but when you're looking at the Asian markets, that's where we're trying to find the low of the day, the high of the day. We're trying to see those opportunities, but always bear in mind that even if you take a trade in those markets, that there is likely to be a reversal occurring in the market, which will go against the earlier trend. But at the open of the London session, if it sets up like we're looking at the Hang Seng 50 and the Euro, the trend may resume again in the direction that you'd have taken earlier trade. So be prepared if it reverses to exit out of your trade. And if you still sit in the market and you come back and look at it, jump in again. Okay, then when you come to the move from the London Open to the US Open, typically, when I say typically, again, 60% of the times, you might get a trading range forming, an attempt to reverse the trend. So if there's a strong trend, there might be an attempt to reverse the trend at the open, but it might fail, and out of that trading range, the market may continue to trade. So there's always opportunities 24/7. Just be aware at what particular point you are trading. So having a look at the US 500, some things that have picked up. So there's that low, tried to break out beneath it, failed, decent enough bull reversal candle. So if you're a bull, if you trade in the way that we trade, we say fantastic. We've seen the double bottom, okay, lower low, double bottom, reversed. Now all you wait for is to see bull strength. So from here, I would have wanted to see bull candle, fantastic. So the bulls have triggered a buy out of a double bottom. I want to see follow through to see if the bulls, after triggering that buy, are able to put a candle or a bar completely above the moving average, which shows strength. And then, of course, there's an attempt to reverse it, which they've been fantastic. Then we look for a higher low. But we didn't get that here. We had a good close. Then, the market gapped down, came up again, tried to break. So we went sideways, trading range price action. that is enough, good enough information for me to say, okay, there is something wrong with the structure of this double bottom. It's still a double bottom, but why have the bulls failed to capitalize on it? We've gone sideways in this market, which means it's an area of agreement, in which the bears have shown strength because the bulls were controlling it from the double bottom. So then the trend resumes, the bear trend resumes, lower highs, and the bears are trying to reverse the little bullish strength that we had. And their goal, what is the goal of the bears? The bears have got strength out of this trading range. Okay, so breaking out of a trading range, we expect this little trading range breakout to fail, so a bit of a tail there, not a problem. But it's a good enough candle for the bears because at some point the bulls tried to reassert themselves with this tail here. It was a bull candle at some stage. So the bulls tried to assert themselves and say, okay, hang on a second, we didn't show much strength here, but we can create a bull candle and then follow through the next day. But by the time the day ended, they had failed, and the bears had continued the sell, triggered another sell. So this market is presently favoring the bears. Okay, we're beneath the moving average. We've got some levels that the bulls are strong, they have to break through. So for me, I'm looking to sell. Why am I looking to sell? Because of all the factors I've mentioned, that where am I looking to sell? If the market reverses anywhere in here and we go to the 5-minute, we can do that. But high of yesterday is a pretty key level of resistance because at that point, yesterday, the bulls were strong, but the bears reappeared in the market as the bulls were testing that low. So previous day was very good for the bears. They broke beneath that low, broke beneath that trade range price action. The bulls tried to reverse it, but when they got to test that breakout point, they were repulsed, end up as a bear candle. So again, at that level or at the 50% level, and I'll show you just now, I am looking for a potential reversal. And if I see that reversal set up, I'm going to sell. So S&P 500 with that in mind. Okay, so we don't need this for now. Okay, so that's what we've been speaking about. Low of yesterday, high of yesterday, 50% level. Market went sideways at the 50% level. But bulls have broken above it. I'll talk about this breakout very quickly. But always you must be saying to yourself, well, if they break above the trend range, where they're likely to go. Measured move in that area. Another interesting point, I'm going to show you, but it's going to be a bit messy. I'll explain what this dotted line is. If you go to the monthly chart, okay, you have high of last year, the blue line in there, which is also obliterated by the green, which is all-time high, but low of last year. Point I'm trying to just get across to you, this here is a midpoint of last year's trading range. So the market breaking above that, coming back, that's a key level of resistance. So we have 50% level, which kind of coincides with that lower high there. We also have, there's a high of yesterday just above there. We have a measured move of this trading range price action. So this one is worthwhile looking for shorts, bear in mind the whole history. Now, because this is the US bellwether, there'll be a lot more volumes kicking in when the US markets open. So even if it goes sideways, etc., keep it on your watch list and see what happens by the time we get to the US open. All right, guys, let's have a look and see what's happening. So we're going above, pullback, measured move. We're here at the leg 1, pullback leg 2, measured move for the euro. So you'll notice I'm not one to quickly change my mind. I'm looking for shorts. I'm going to quickly change my mind and say, oh my goodness, let me jump in and go long. My brain can't process things that much. wedge pattern, market went up, came down, went up, came down, went up again. So third time, level of support. I'm going to keep looking to see if we create a low high anywhere in that zone. Hang Seng 50, again, okay, still playing out, and S&P 500. All right, guys, we are out of time. Please pop questions into James and Mai at the office if you're interested in the Wednesdays at the market. Just come and participate. The second Wednesday of every month is free. And then, there's another product that you'll find exciting, which you have exclusive access to the third and fourth Wednesdays of the month. 8 hours each Wednesday. Hope to see you in the market. Thank you, guys. I appreciate it. Thank you, Mai in the office. We'll catch up again next week.